Good afternoon and welcome to the Tonya Esquibel Real Estate Show. Tonya Esquibel here every Saturday from noon to 1, the original real estate show right here on Super Talk 99.7 WTN. You know, in this environment, as we're getting into fall, we're getting into winter, it is not too late to achieve home ownership in 2023. So give us a call to find out your purchasing power. There are so many programs. We have over 14 that will allow down payment assistance. So call us at 615-300-0794. Everyone's financial DNA is different. So don't sit on the fence. A lot of opportunities, and that's what I'm excited about. I have Kim Hollingshead in studio with me, my co-host, and you bring so much energy and positive to our business. I mean, we were at a meeting this last week and I heard about it. I was told over 20 times how much they love Kim Hollingshead. And you do have a choice when it comes to a title company. So she's an amazing real estate attorney as well. And today's focus, we really want to talk about educating the difference between what are the advantages in a seller's market and a buyer's market.
Yeah.
Because everyone's kind of sitting still right now wondering, is it a good time to buy? Is it not a good time to buy? And what are the advantages if I'm a seller? So let's start the show today. If I'm a seller, what would be my advantage to want to even get a realtor and sell?
You know, everybody has to sell at certain points in their life, right? It's not necessarily always going to be a blanket rule whether it's a good time to buy or sell real estate. You really have to look at your own personal circumstances, don't you? But I don't think that now is a bad time to sell because the prices of real estate haven't gone down. So if you're a seller and you're just looking at your pure pure profit, or what are you going to net off of the sale of a property, you're not going to net anything less in this market than you would have a year ago. I mean, the prices just aren't going up at as high of a rate as they were before, but they're not going down. So, I mean, I think that's one of the things that makes this buyer's market a little unique, is that the prices aren't dipping.
Yeah, and so a lot of times I hear too, the seller, like we're talking about advantages to sell. The seller is locked in to a rate that they just don't want to give up.
It's true.
And so where I'm seeing from a buyer's advantage, if you're looking at where do I buy, is it a good time to buy? The most aggressive that I see is in new construction right now, because they have the inventory.
Sure, yeah.
And that builder developer went from prime was 3.5% for so many years to where today it's 8.5%, depending on when you're tuning into the show or listening to our podcast. And that's a huge difference in carrying cost.
Yeah.
And that is where builders are willing to negotiate to get that moved off their books, because now their carrying costs are, 3 times more what it was before. And so I feel like a buyer has a better advantage than a seller right now.
Oh, way better, right?
The buyer doesn't think that because they think rates are risen.
Yeah, isn't that so interesting that what we hear in a seller's market is buyers say, well, it's a seller's market, and properties are too hot on the market, and I just don't want to get in a multiple offer and a bidding war with someone. It's just too intense, and it just feels too stressful. I don't want to get involved in it. But it's the fact that the rates are low is what's driving that kind of a market, that seller's market. And it really does slow down, and it becomes like the pace of it slows down is what I mean. That you're able to really take advantage of things like incentives that in new construction that they would offer in a buyer's market. But the hallmark of a buyer's market is rates are higher.
Yes, that is true. And the buyer thinks it's not the time to buy.
Because rates are high.
Yes, to where it really is the time to buy, because they're not looking at that, hey, maybe that home would have cost them $50,000 to $75,000 more 2 years ago at the 3% interest rate. And so you have to balance that out and look at it, because now you're getting discounts that you've never had before.
Especially not during 2021, 2022. I mean, when people were coming to the table with tens of thousands of dollars to cover an appraisal gap. I mean, and then they were not getting inspections. They were not getting repairs. They weren't even asking for them. They're doing whatever they had to do to make the offer as sweet as possible so that they could have their offer accepted. And, FHA did studies, and of course they're always tracking the number of FHA loans and VA loans that are issued. There are so many resources online where you can go and look up the actual numbers. And in 2021, that was the lowest rate for FHA loans that they had seen in such a long time. And the reason for that is because those offers weren't getting accepted at as high of a rate as, say, a cash or a conventional offer. So if you need to be able to put down 3.5%, it's actually better for you to be making offers at a time when the rates are a little bit higher, because you can then compete with a conventional or a cash offer. You can't compete with them when the market is as hot as it was in 2021.
Yeah, break it down in my mind as an example. Okay, I'm a buyer.
Yeah.
2 years ago, let's just, because that's when it really started, maybe a year and a half ago. Over asking price, multiple bids. I don't know if I'm going to win this bid. I've been to 20 different properties. I'm paying $50,000 more. Let's just say that's on a $500,000 home. That's what we saw. If you are in $1 million, $1.5 million, you might have paid $100,000 more, but over asking price, just because there was such a demand because rates were so low.
Right.
So let's fast forward that scenario and go, okay, even though rates are higher right now, I can actually pay less for that home. Not only did I pay maybe $100 above asking price, if we look at the $1 million market, not only did I pay $100 over asking price, but right now the seller is discounting $100. So you might have $200,000.
Yeah.
So your rate might have went from 3% to mid sevens right now, but you have built-in equity from the negotiations because of the market shift. And you can always refinance the rate. So you need to buy the house.
Yeah. And you know what? I think a year ago, it's interesting because rates have risen for how many months straight? Is it 20, 21 months straight now? That rates have gone up. And so I remember, this was like a year ago, someone said, a buyer had asked the loan officer in front of me, like, yeah, but shouldn't I wait for rates to come down before I buy something? And he said, rates have been going up for a year now, and there's no indication that rates are going to come down anytime soon. And guess what? They've been going up for almost another year after this conversation took place.
Yeah.
Now that rates have been going up for 20, 21 months, we have a little more certainty now as to when everyone really believes that rates are going to start to level off and maybe dip down a little bit. So that uncertainty, as far as the rates were concerned, it's not as prevalent today as it was, say, a year ago. And I think so then that goes to your point of, well, then the conversation becomes, well, you can refinance at a later time to get, and so now there's more certainty that we believe. I think there's a general consensus in the mortgage market and across all areas of real estate that rates are going to dip down to the fives and maybe below 5 by 2025. But in next year, I think the general consensus is that they're going to hit the fives at some point.
So there's no ever guarantee on
Right,
rates.
never a guarantee. We all have ideas.
All we know is right now, a year and a half ago when I was trying to buy a home, I'm going to pay way more than what it's worth because I'm paying over asking price.
Way up.
Now you have that seller. That's what I'm saying. So if you're paying a 3.5% rate to a 7% rate or a 7.5% rate, you're looking at, depending on your price point, obviously, and your loan amount. I mean, maybe that's $10,000 a year, but you might get that home $200,000 less than you could have 2.5 years ago.
Right, you can finance
so the buyers are so consumed with, oh, rates are higher, I'm going to wait until they go back down. Well, what happens when they go back down? You made the perfect point opening the show. Yeah. You're going to get multiple bidding wars, and we're going to switch back to a seller market. And I think that is the missing education piece for buyers to really understand that, because you're getting deals that you were not getting a year and a half ago at all.
Right. And there is so much pent-up demand.
And then the refinance, like you mentioned. So let me close on that point. You were saying that it might get back down to the fives. But what if it doesn't? What if it just stabilizes and then investors come out and they offer aggressive ARM programs, 5-year, 7-year, 10-year, and you refi into that at maybe a 4 or 5% rate? Because a lot of lenders will not charge you lending closing cost to be able to refinance. And so that's where it goes back to take advantage of, why would I want to give up? And these are rough numbers. give up 100 to 200,000 hypothetically that a year and a half ago I couldn't get, that might cost me 10,000 a year. Look at your recoupment on that. It's better to pay the higher rate.
It is better to pay the higher rate, right? And finance, you're able to finance it today as opposed to a year ago. So what, for the listeners who may not be as familiar with what we're saying, is that let's say that you're buying $1 million home and you're in this multiple offer bidding war. And what you do is you say, I'm going to beat everybody out. I'm going to offer 1.1 million. And then the appraisal comes back, because the appraisal is based on the last 12 months of sales. So it doesn't matter what your offer is. The appraiser is looking at past sales. So it's always like a little bit behind. And so the appraiser comes back and says, you've made an offer at 1.1, but I'm sorry, this house is only worth, or I'm going to value this home at $1 million. So now there is a $100,000 quote appraisal gap that you are going to cover with cash out of your pocket to buy that home. You cannot finance that because it's over the appraised value.
Yeah.
And so now in this market, not only are you not going to have an appraisal gap because you're not in this multiple bidding war heated situation, but you're saying that the seller could also possibly discount the home because they want to unload it quickly.
Yes.
And so you're not only saving the $100K that you would have to pay in a seller's market, but also getting that discount, and you get to finance the whole thing. You don't have all this cash coming out of your pocket. I agree with you. I mean, cash is king right now. Anytime we're in a market like this, any kind of a financial situation, generally across the board in the whole country, hold on to your cash if you can, right?
And I think a lot of times too, when we were in that seller's market and rates were so low, everyone wanted to go buy. And it's kind of like stocks. When everyone's buying stocks, that's when you should just sit still.
Yes. Yes.
Because there's going to be a shift in the market. And so we're seeing that shift. And that's where I want to encourage buyers to know, even though rates have risen, you've still got great opportunities to get discounted prices no matter your price point.
Right.
I mean, $500,000, I'm seeing $25,000 in closing cost. A year and a half ago, I would talk to a real estate agent or a builder to say, hey, do you want to pay some closing costs? They're like, no, I don't need to pay closing costs because the demand.
Yeah. And
now we're seeing 25, 50, 75. If you get into 2 million plus, we're looking at almost $200,000 a seller's willing to negotiate, to where a year and a half ago was not available.
Exactly. That's the hallmark of a buyer's market.
I know everyone says, don't marry the rate. I know that's a cliche, but it is, honestly, when we break out the math, because we know we love the math, if you're walking in with that much equity that home was valued over. The flip side of that we can talk about, because I know some listeners out there are like, well, our home price is going to sustain. And that is the question we'll talk about when we come back. So you're listening to the Tonya Esquibel Real Estate Show right here on Super Talk 99.7 WTN. Welcome back to the Tonya Esquibel Real Estate Show, here every Saturday from noon to 1. In studio with me is Kim Hollingshead, Hollingshead & Associates real estate attorney, and helping families all across Tennessee to get into home ownership. Also, you help clients of mine in Florida too. So don't think you're just limited if you want that second home in 30A in Destin that everyone seems to want at times. Just know she can help you as well. And at any time, if you would like to get any information, find out your purchasing power, have a conversation with Kim, call our local team, 615-300-0794, 615-300-0794. So if you're just now tuning in, we're actually talking about the difference between a seller's market and a buyer's market. And buyers felt that their market was a year and a half ago because rates were so low. The challenge is, if you look at it as a shift of where we are today, that was really a seller's market, because if a house was listed for $1 million, you had multiple bids coming in, and it could be $100,000 over asking price, and you would just come up with that money. And that same property today, it's not an overbid offer that's typically happening, but that seller could actually discount that home now $50,000 to $100,000 because they want to move it. So this is the best time to really buy a house because of the equity and the difference between where we were a year and a half ago and today, even though the interest rates are higher. And so if we look at that $200,000 example that me and Kim were just talking about, and hypothetically, obviously, everyone has different price points, different loan amounts, but you might, with a higher rate, pay $12,000 to $15,000 more per year. But if you would have paid $1.1 million versus $900,000, how many years would it take you to recoup that $200,000 that you saved in equity based upon where the market was a year and a half ago and where it is today? Mm-hmm. So then we have the flip side of the conversation before we went to break and said, okay, but what if home prices fall?
Yeah,
what's
they're not
my
going
value?
to.
Okay, so
They're not going to fall.
let's get your input on that.
Right? I mean, we have such a shortage of inventory, well, across the country really, but here in Middle Tennessee, especially in new construction. Mm-hmm. So traditionally, new construction has always filled the gap in any kind of inventory shortage. Back in 2009, we had an excess of inventory. There was just such a surplus. And that is part of what drove the home prices down. Obviously, it's just basic supply and demand. And right now, there's no inventory. You talk to any realtor out there, there's just none. Mm-hmm. But where, to your point, that new construction is always there to sell to buyers in that buyer's market. Even when existing home inventory is low, you typically have that new construction. But permits being pulled at low rates right now, and there's just not a lot of builders throwing new inventory on the market. Mm-hmm. So that's keeping the prices higher. Also, Wall Street continues to buy real estate. And we talked about this last night, that the largest investment firms on Wall Street are gobbling up real estate to the point where some predictions are saying that at some point in the next couple of decades, they'll own 60%. Wall Street will own 60% of the real estate in the country. Wow. If they continue on their mm-hmm. current trajectory. And so with Wall Street buying, there's tons of build to rent neighborhoods. So Wall Street firms and these build to rent companies, they'll go develop and build an entire subdivision that before would have been sold mm-hmm. at an affordable rate mm-hmm. to working class families. These are like, your typical 1,600 square foot, 3-bedroom, 2-bath, no garage kind of homes. And now these companies are just renting out the entire subdivision. So those are homes that are not being sold to families; they're just being rented. Mm-hmm. And if you go downtown and you sit in any kind of a courtroom where they're handling evictions, you're going to see so many of these build-to-rent companies in there handling all of their evictions because they have so much of the rental market here. So these are the factors, and these are not the only factors. Also, multifamily financing is at an all-time low. It's not going to bounce back anytime soon. So there are just multiple factors, multiple reasons why. Yeah, they know that inventory is going to remain low. It's not going to bounce back, and prices are not going to go down. So yeah, it's hard. Rates are high, prices are high, but that's what's making it a buyer's market.
That's where the opportunity that a lot of people don't see.
Yeah, exactly.
So yeah, you mentioned there's this article I get all the time. I subscribe to so much stuff, and so I'm like, okay. Housing starts drop to the lowest since 2020, while permits rise. Goes back to our conversation about the opportunity with new construction.
Interesting. Because
we mentioned at the opening of the show that seller just does not want to give up his 3% rate.
Right.
Or his 3.5%. And the opportunity for me, I love new construction, always have, for me to be able to share with a client that you can walk into a new construction home, get $20,000, $30,000 incentives that you couldn't have got a year and a half ago. Plus you've got warranties in place. Because we did talk about that. Yeah. We're like, why do, off the air, we talked about why did some clients choose not to buy? Well, they don't want to deal with the, garbage disposal, the dishwasher, maybe the AC goes out. But when you buy new construction, you have warranties.
The builder's warranty.
Yes. And to know that they're willing to negotiate and give you incentives, and then you get something brand new. nothing against resale homes at all. It's just this is where the market has shifted.
Right.
And that's why we have a
rely on
shortage of
construction.
inventory is because the sellers are not wanting to put the home on the market because they don't want to 3 to 3.5 go to 7.5, which is pretty much where our market is. And so they're kind of sitting still to see what's going to happen.
But guess what? Everyone still has to move. Their families grow. They get better paying jobs. And everyone still wants to move every 5 to 7 years. So everyone who's sitting in their house now because they don't want to give up their great rate, at some point the rates are going to go down low enough that they're not going to feel the pain of losing that rate as much, and they're going to be willing to sell their home, put it on the market, and go buy a bigger, nicer home. And so that's why we know that there's going to be there is a ton of pent up buyer demand. And when the rates go down, everyone's going to hit the market and prices are going to go up.
Yeah. And that's why you need to buy now.
Well, and
it's like,
yes.
And it's hard for someone to understand that. And that's why I wanted to say, what is the negative to not buy right now? Yes, your rate's a little bit higher, but in these scenarios we're talking about, you're typically walking into a better equity position than you would have a year and a half ago. So that is a justifiable cause. Your rental rates are going up. They're not going down.
Yeah, rent's continuing to go up.
When you pay the rent in 1 year, 2 years, 3 years, it's still zero in your like equity. To where if you own a home, as you mentioned, we can always refinance. And even if the 30-year fix doesn't go down, at some point investors are going to come out and offer aggressive arms. They're going to offer different programs to keep home ownership going because that's the number one way to build wealth.
Yeah.
And we're all in a
agreed.
transition, I think, going into what is the Fed going to continue to do? Inflation's still high. We thought they would be balancing it. It's the quickest increase I've seen in my 29 years. And we're going into an election year next year. So all those are factors that I think a lot of people are sitting still about. But one thing that we kind of go through different seasons, and the last week I've had more new leads coming in than I have in the last month.
That's great.
And I'm
Love
curious of what your thoughts are of why that is, because typically as you're transitioning into fourth quarter, it could be some of the slowest periods. So are buyers really starting to see and understand, even though rates are XYZ,
Sure.
I can get a better home right now,
And
and I can negotiate better.
And seasonally, the winter months, the colder months do tend to, slow down a little bit on the housing prices. It tends to, you tend to get a better deal in those months as well. Yeah, if you're looking to buy something in January or maybe December, now is a great time to call a loan officer and to get that started. And I love that little secret tip. So you just kind of touched on it for a second, but you didn't really go into it in a ton of detail. But if you listen to the show today and this is all you get out of the show, this is worth it. So go back to what you said about refinances and how you don't pay the same fees on a refinance that you do on a purchase.
Correct.
And so that is a deterrent for a lot of people. They think it's hard enough to get one mortgage. Why in the world would I put myself through this again in a year from now? Is Tonya crazy? But the truth is, it's not as hard to refi, right?
No, it's not.
So what is the big difference, you think?
I mean, so the costs are less, but obviously you've got an established mortgage that you've been paying on time. You still have to requalify with income, assets, make sure your credit score is there, unless you're a VA or an FHA loan. And then you can do streamlined refinances and a VA reduction. But if it's a conventional loan, you're still going to qualify. It's just even the state of Tennessee won't charge you as much. And so if I have a client that comes to me that's a past client to refi, I won't charge my lender fees. The title company gives a discount. The state of Tennessee doesn't charge the full state tax stamps that they do on a purchase.
Yep.
So it's just not as much cost-wise, but you do have to go through the loan process again.
And there's two kinds of refis, right? So there's cash out and no cash out.
Yes.
So what's the difference there?
So cash out is basically depending on how much your home is worth and how much you owe if you can pull equity out. So a lot of times on conventional, you're looking at 80% loan to value, and then on FHA, 85% loan to value, and then VA, you just have to calculate it. So there is a difference when it comes to interest rate to pull cash out versus just doing what we call in our industry a rate term.
Right. The rate is just slightly lower when you're not,
pulling
cash
out any equity. Yeah.
And you're just refinancing the rate. And what you do is you actually use the equity in the home to cover all of the fees and any kind of discount points as well. So in order to refinance and to hit that lower rate, it actually, you don't pull any money out of your pocket, right? Or you can if you want to, but you don't have to.
You don't have to, no.
And on a cash out, you actually you refinance to pull cash and to pull equity out, basically exchange that for a cash out payment. And then what do people typically use that cash out refinance to do?
A lot of them do home improvements. They want to improve the home that they have. Some will do, number 2, I see, is debt consolidation. Maybe they went through a season, medical, health, job loss, and used their credit cards too much. And so instead of paying 27, 28% interest, or even it's 20 or 22, doing a cash out at 7.5% in today's market is still better than paying those high interest credit cards. So that's number 2. The other one that is at the top 3 would be, unfortunately, clients that are going through a divorce. And that was a show that I did years ago, and I do think that is something for us to strategize about, because I think there's a need for, just from what I'm seeing.
Yeah.
It used to be called mydivorcedoneright.com. I bought the domain, and divorce attorneys, basically, when I did this 10 years ago, and you're an attorney as well, recommend if you're getting a divorce, just quit claim over your interest. But if they were both jointly on the credit obligation, they're both credit responsible. So a normal consumer thinks, I don't own that home anymore. And basically that's the worst thing they could do, because they just gave over their interest, but they're still obligated by the creditor. And so I used to see, and this was back when we went through 2008, 2010, 2011, a lot of families, because of the financial constraint, unfortunately went through divorces. And that was my passion, to educate them, like, don't just quit claim over your interest, whether it's your house, your car, like cancel the credit card. Because I had clients start to apply with me, and they had no idea that the other spouse was not making the payment. And so their credit scores plummeted. And now they could not financially move forward and buy a home. So that's why I called it mydivorcedoneright.com from a financial standpoint.
I love that.
And I think that we could start to see that shift again, going into probably, end of this year and pretty much next year, because you're seeing so much pressure when it comes to inflation. I used to go get a hamburger for $9, and that was an expensive hamburger. And I went to a restaurant today, and that hamburger was $18.
Oh my gracious.
I mean, that is the reality of what you see, and that puts pressure on relationships and marriages as well.
Wild.
So those are my top 3 things that I see people needing to do a cash out refinance: home improvements, debt consolidation, and if you're going through a divorce.
And see, you don't have that opportunity if you're renting. No. See, you don't have that little safety net. You're going to pay the $30,000 or $40,000 a month or a year anyways. You have to pay it to your landlord. Why would you do that? Just pay it to yourself. Is it a hassle to get a mortgage? Yeah. Is buying a house stressful? It is a little bit. And that's okay. If someone said, hey, Kim, I'll pay you $30,000 or $40,000 to endure the stress of a one-time process, I'd be like, pay it to me.
Yeah.
And I pay it to myself.
Yeah. It's a 30-day process typically to close. But the actual mortgage part of it is maybe
the leading up
20 hours of the month.
Yeah.
So for 20 hours to make 30 or 40 grand.
Right. I mean, pay yourself.
And then to get a little bit upset because, they asked for this pay stub again, or we didn't know that you're 1099, not W-2. Oh, maybe here's another one. We can talk about this. We got to take a break right now. But I've been in the same line of work, but now I went from 1099 to W-2, good, but then I just opened up another business in the same line of work and I only have 4 months on my tax returns. Can I get a loan and count both income? Because I need both. And I don't want to be a co-signer because I'm a responsible adult. What do we do with that? Stay tuned. You're listening to Tonya Esquibel Real Estate Show right here on Super Talk 99.7 WTN. Thank you so much for tuning in to the Tonya Esquibel Real Estate Show. Here with me is my co-host, Kim Hollingshead and Associates, real estate attorney. And I'm just going to jump right in because as we get talking, we just run out of time. And I know that we're going to be running out of time pretty quickly. So I'm going to jump right in. But at any point, if you would like to find out some information in regards to a mortgage, who's a good real estate agent, who's a good builder, you have a choice to your title company. Don't just let someone just write it in your contract, because there is a difference in being protected with your title. And me and Kim will be talking about that toward the end of the show today as well. But give us a call, 615-300-0794, 615-300-0794. Also, if you it's your first time to listen to the show and maybe you're intrigued and want to learn more about home ownership and what does that look like, and just be able, we've had multifamily investors on, investing in real estate, building real estate. You can always go to our podcasts, our social media reels, but always can call us as your local team of experts, 615-300-0794. Okay, so let's just kind of jump in. We left off of the fact to kind of recap, if someone's just tuning in, it really is a buyer's market, even though a buyer doesn't think it is because interest rates have risen. Yeah. Because sellers were demanding way over asking price a couple years ago, a year and a half ago, to be more conservative maybe in that aspect. But I felt it January 2 years ago from this side of it.
Agreed, yeah.
And then we were talking about the interest rate difference is, yes, it has increased. But if you can walk in and get, anywhere from, depending on your price point, we used $1 million as an example, walk in with, year and a half ago, you paid $100,000 over asking price. Now the seller might be willing to discount it $100,000. That could possibly be $200,000 to where your interest rate might only be $15,000 a year. How much longer does it take you to improve that? And you can always refinance. So we were talking about the top 3 reasons to refinance before the break. Number 1 that I see is a lot of home renovations. Number 2, debt consolidation. And number 3, a divorce situation. So they can remove themselves from their credit. And then we talked about what are holding people on the fence in regards to maybe stepping forward. And some lenders can get some things approved and some lenders can. So I'm going to ask you, because you've been doing this for a long time as well.
Yeah, how did you get the 4 months of income qualified?
4 months of self-employed.
How did you do it?
Income approved. Because that's what we do.
That's pretty good, sister.
It is. And that's the first time I've ever gotten that exception. I've done 1 year before. But never 4 months.
4 months. But that's why you're the closing queen.
And there was 2 streams of income. And normally you have to have 2 years to carry 2 streams of income. So I think sometimes consumers, you were talking about how they're thinking it's too hard, it's too frustrating. Yeah. But you might spend 20 hours, it's usually a 30-day window, to possibly, as we talked about, own a home. And we know that you're going to gain equity. Even if you have a high, prices come down, they come back up. I mean, look at people that should have held on to their home in 2008, and if they would have sold it in 2019.
Exactly, Tonya.
So, and you got to pay somewhere to live.
Yeah. Real estate prices just keep going up. They're not, overall, they're not going to go down. They just may not increase in value at as quick of a pace as, in some years as they do in others. Yeah. But it always goes up. This conversation started because I had someone say to me, well, the first time home buyers I'm talking to are saying, I don't want to deal with the hassle of buying a house. It's just easier for me to renew my lease or go find someplace. First of all, you have to pay a security deposit. And when you buy a house, you may not have to pay anything down. Tanya's got 13 different loan programs.
Up to 14, yeah.
Yeah, my goodness, tons of different loan programs.
And you don't have to be a first-time home buyer. Some of them are loaning money for non-first-time home buyers.
You don't even have to be a first-time home buyer.
Just to help down payment and help home ownership.
Right. So you can flip into that bigger, nicer home or whatever you want to do. And then, and you also, this is another common misconception. You don't have to always be a U.S. citizen to buy a house. That's a very common question. I know you do ITIN loans. And so please don't let that deter you.
Yes.
The American dream is available.
Foreign nationals.
Yes, it is available for foreign nationals as well. And it really is the American dream to own a home, to have that stability, because it may feel easier to walk into your landlord's office and to sign a lease and feel, because you're familiar with that. There are no questions. There's a lot of certainty around that.
Yeah.
And buying a home feels very uncertain. You're trusting some real estate agent. You're trusting a loan officer. You've never done this before. And there's a lot of moving parts and it can feel very confusing. So I understand why some people say, oh, it's just kind of a hassle and I just don't have the energy, or I'm just not, I just don't want to deal with the stress of buying a house. But here's the thing. You deal with the stress one time, and then after you become a homeowner, it's so much less stressful when you own a home. Number one, because you have that safety net, like what you were talking about with debt consolidation. And when you get it and being able to make improvements on your home, and, and you're paying that money out in rent anyways, you can pay yourself that money. So you are like your own landlord in a way when you think about it. Not having your rent increase all the time, not questioning whether you're going to have to move in a year. I mean, there are so many people who are renting now that they know exactly what I mean. It doesn't matter whether your landlord will renew your lease year over year over year, or if you're in a month to month. It doesn't matter what your situation is. You never really get that feeling that you're settled.
Yeah, you don't. And then there's just something about owning your own home and walking into your own home. I know we've talked about that before too.
Yes.
And it's kind of that, we talk about doing vision boards and goals.
Yes.
It's just like that goal that you met, and to know that you're building something and you did it and you actually own something. There is something to be said that I think is beautiful about that.
Yes.
And like I said, anytime that I get to purchase and close a home, I'm just as nervous as. It sounds crazy because I've known the business for 29 years, but I know the anxiety of just applying for that mortgage. I have a banker that I've known for probably 25 years. And so even though at Cross Country, we do more permanent loans, we can do construction loans, but I've always used my local construction person if it comes to lines of credit. And he was like, I need your personal financial statement. I need to renew your loan. And I'm like, oh my gosh, what if I don't get renewed?
Right. When they ask you for your most recent tax returns and you're like, oh my gosh.
Yes. So I understand that anxiety, but it doesn't mean you shouldn't try.
No,
and like we said, even if you go through 20 to 30 hours, the lady that I helped do the 4-month income, she actually went under contract this last week because she was like, I don't want to be a contingent pre-approval. I don't want to go through the emotions of negotiating a contract unless I know that you can get us approved. And so at Cross Country, we can go directly from that loan officer application into underwriting. We don't have to do the old fashioned, let's go to processing. A lot of banks want you to have a property before it even goes into underwriting, right? So we have that expressway. What's the best way to call it? Everyone's like, what's fast track? I'm just like, it's like expressing you into underwriting. It's not a pre-approval from a loan officer. It's actually an underwriting commitment letter. And so we talked through her entire history, like her work history, what are the methods behind it. You've got 2 sources of income. Typically that takes 2 years to count it. And typically you need a minimum of 12 months. So I was very honest up front of what she needs. Yes, like this is just not an easy exception. But I think based upon what you've told me, this is what I recommend doing. And so she wrote a really good letter of explanation. She provided, and it was a very strong explanation, a very strong company, like right out of the gates, great revenue, minimum expenses, and was able to provide a profit and loss statement along with it as well to show what the income has been. So when I say 4 months of self-employed, that is usually your tax return year.
Right.
And so that's all I had. But I have almost a whole year, 8 or 9 months into 2023 to try to support that business is continuing to grow. And she was really smart from the standpoint of when she set up the company, she W-2'd herself. So she was not trying to take home any more income as far as the profits from the business besides what she W-2'd herself. The other thing is it's all tied into her same line of work. So even though she didn't have 2 years of part-time jobs, it was all within her rim of employment. And
Love
so
it.
it just reminds me sometimes of exceptions I've got where someone can go 1099 to a W-2 or a W-2 to a 1099, and it's putting all the pieces together because your underwriter, it's like a puzzle to me always. If you just throw in a few little pieces and they can't see the entire picture and you can't connect the dots, they don't pick up the phone and call the bar.
Yeah.
We have to put together the story as a loan officer.
Yeah.
And we have to make sure our production assistants, loan partners, processors put the story together well, and we have well-trained people. So I mention that just because so many clients are so rate conscious, which they should be. I'm rate conscious when I get a mortgage or a car, like we all are, right? But we went from an environment to you just push a button in client's mind and you just get an automated approval and you move on, because the market was so different. Now the market is, you can still do that, but these clients that I'm talking about are 800 credit score, 780 credit score, 760, putting 20% down. It's just their income is outside the box. So if you just call some online internet company, try to Google it on your own.
That's the skill of an experienced loan officer.
And that's why
That's the difference.
Locally, we started the show years ago to help educate people. And also, you cannot just get that type of income through a computer.
Right. I mean, I don't want I love to work with realtors and loan officers who have a great book of business, right? We love the easy closings, but I love it. Even just yesterday, I was on the phone with a realtor and called me and, huge problem, last minute, what do I do? And I said, oh, see, now this is the reason why you close with me. Because of this situation right here. Watch, I'm going to get this closed for you. And somebody else may not have been able to do that closing or think outside the box or, solve that problem. But we are able to do that. And that's essentially what you're saying is, well, yeah, and that's the reason why you get along with me.
And I think that goes back to the reason I've always wanted a title partner as my co-host on the show, because it has to be someone that understands a little bit of the mortgage and I understand a little bit of your world. And it's coming together to go, oh my gosh, how do we figure this out without, getting the agents upset or getting the clients upset? Like, we can diffuse it before it actually happens.
Oh, sure. 9 times out of 10, the consumer has no idea that we've done something behind it. And they shouldn't.
And we might be back here going, I can't sleep tonight. I'm waking up at 3 a.m.
Right. We're on the phone with the staff. Hey, what did they say?
Kim will text me at 5:30 in the morning.
I do.
So it's like there's so much that goes on behind the scenes in the mortgage industry, but that's why we're so passionate and continue, to take our time and to educate people.
Yeah, we don't want people, exactly. We don't want people to be deterred from buying a house because of the stress or the perceived stress. And they don't have to be stressed when they have professionals behind the scenes working on their behalf.
Yeah.
If your income's a little funny or you're not sure about your credit score, whatever, don't let that stop you. Just call Tonya and she'll solve the problem.
Yeah. We're working on a client right now that just got denied by another bank. And I mean, when I'm looking at a DTI, debt to income ratio, sorry, our acronyms with mortgages. Yes. If it's a 53, 54, we're going to figure it out. I mean, that is too close to not figure out.
Right.
Especially if they've got, tons of savings. But this particular client, I can talk about clients all day long because I just love it.
You just love nerding out on this stuff.
I do nerd out on it. But they are on retirement Social Security income. Even though they have millions of dollars, it's just how do you figure out the qualifying income? Again, I think this client was 787 middle credit score. So I only say that because a lot of people think that lenders, because we got this bad reputation back in 2008 because we were just giving money to anyone that could breathe. But it was really Wall Street offering these programs and Dodd-Frank, the government offering these programs to be able to do that. But I want clients to know and listeners to know that even though you have a 780 credit score, if your income is a little clunky, it's just probably you need to sit down with a local person to figure it out. And I'm not going to be the one, if it's 120 DTI, I'm going to be like, whoa, we got a co-signer, you got to drop your sales price. But I'm like, and this person had banked with this bank for over 35 years.
It goes to show it's not about how much money you have either. High net worth clients have an equally difficult time qualifying as, regular average income people.
Which doesn't seem fair, but we don't write the guidelines. And
yeah,
so
it's hard for everybody.
Yes. So my thing is how to navigate you to fit you in the box, the mortgage box. But one thing I want to talk about, I told you we're going to run out of time.
It's
again.
okay. I like this conversation.
But I want to talk about what is title insurance, because as closing cost is the number one question. Why are closing costs so high? And the reason I want to talk about that is because for the first time, the last 2 years, you're probably seeing in my book of business, 99% of clients paying discount points, which is another 1%. So we were always typically 2 to 3. Now we could be 3 to 4.
3 to 4, yeah.
And I've always...
They're looking where can they save money. And this is true, because I had a client the other day who said, now look, you have to get title. The lender's going to require that you get title insurance. So if you buy if you're buying a house with a mortgage, you're going to buy a title insurance policy regardless. But the mortgage company's title insurance policy is a different kind of policy. And this is so important to stress, because a lot of consumers think, well, I'm buying a title policy for the lender. Well, and I'm, why would I buy one for myself? Or why do I have to pay the extra $50 or whatever to buy one for myself? It's because the lender's covered, right? The lender's coverage is different. It's not the same coverage. And it's to the point where the other day I had somebody who was fighting me tooth and nail that they didn't want to pay the $50 to insure themselves. And I just said to Emily, I said, no, I don't care. It's important enough. You just let them know that Kim said it's so important. You have to have this. She's going to pay it for you. Take that discussion off the table. They're getting a policy.
Yeah.
You have to insure your investment.
Yes.
And hedging against risk is always, that's why you get health insurance, you get car insurance, right? Because we know that there are certain types of risk out there that can wipe you out financially. And unfortunately, there is an inherent risk in buying real estate. When you own real estate, you could lose it or have unpaid, have liens that haven't been paid off, or unpaid taxes, HOA dues, some expenses that arise. And you've got to insure yourself against those
not
risks.
a clear chain of title, too. I mean, that
happens.
It does. And I've experienced it, and I've been in the business. So
Yeah.
that is so important, because I think a lot of times, and I know we got to take a break, so maybe we'll come back with this, but 99% of the times, consumers don't even understand who their title company is, what the value of it is. And I have personally leaned on the fact of title insurance to help me through things that came up after closing. So stay tuned. You're listening to the Tonya Esquibel Real Estate Show right here on Super Talk 99.7 WTN. Welcome back to the Tonya Esquibel Real Estate Show here every Saturday from noon to 1. Wow, I am so excited about today's show. We have been covering so much material. If you have missed this episode, please go check it out on our podcast, our YouTube channel, our social media. My co-host Kim Hollingshead here with me every Saturday from noon to 1. Been talking about the value of title insurance, been talking about the value of a buyer's market right now, where a lot of buyers are sitting there thinking, is it really a market for buyers? Because interest rates have risen, but you're getting the best deals on prices that you have in a long time. We have over 14 different down payment assistance programs to help you. So if you're thinking, I don't have the down payment money right now, I want to save more money, that might not be the best answer. And the beauty of it is, it does not cost you anything to find out your purchasing power. You can always call our local team, 615-300-0794, 615-300-0794. Thank you so much for all my loyal listeners for over 18 years. It might be 20 years.
Wow.
I'll have to get with 99.7 to find out how long I've actually been on the air. But Kim, I love the show today just because I love providing so much education. I know that we didn't have a guest on, but sometimes we just need to talk about real estate, down payment, the market, title insurance. And before we went to the break, I was just mentioning that a lot of times I don't feel like as a title companies get appreciated as much as they should.
Oh, thank you for saying that.
Yes, because like if sometimes it just gets written in the contract, and like I talk to clients and they're like, I don't know where we're closing. They think we're the closing company.
Yes.
And so for years, and that's why I thought it's been so important to bring on a real estate attorney, a title partner to be my co-host, to educate the value of that. Because if I didn't know that as a lender and being in the business, I would have actually lost out on claims, because I've had 2 title insurance claims that were not caught by a proper title company when I first got in the business.
Wow.
And a lot of people don't think of what title insurance is, but it's basically like your car insurance. It's going to protect you if there's an accident that is there. And the other question we get a lot of is, why are closing costs so high? And now we've got discount points on top of title insurance, on top of government fees that are there. And
homeowners insurance, the recording charges, the state transfer taxes, HOA fees.
Yes.
Yeah, there are some expenses involved in purchasing a home.
But the best thing with that is you can negotiate sellers to pay them now that they were not doing a year and a half ago.
That's right.
That's whether it's a resale seller or a builder. Lenders are paying closing costs as much as they can, but because of the premiums and the rates, to keep the rates down, it usually goes into the seller doing more and a really good real estate agent to negotiate that for you.
Yes.
And I feel like that we've kind of done full circle from the standpoint of you've got real estate agents that have been in the business for years, done great. They're every single market's different. They continue to learn. They continue to educate themselves. But there's a lot of agents and a lot of loan officers and title companies that got in the last 5 years because things were so great. And you're starting to see the difference in representation when it comes to the people that have not continued to experience themselves and can continue to be ahead of the market in somewhat. You kind of see it on my standpoint when I look at loans. When I start to see this activity coming in for my leads, I'm like, and then I start to see this news talking about, prices declining or interest rates rising or clients not qualifying like they used to. Then my mind 6 months ago is already going, okay, team, we got to get prepared for this. This is our market, and we got to start marketing that.
Yeah.
All right.
Exactly.
I took up our whole 4 minutes of the last segment. So you got to take it away now, Kim.
Well, title insurance companies, your car insurance company can't stop you from having an accident. Your health insurance company can't prevent you from getting sick. That's not the point of those kinds of insurance policies. But your title insurance company can actually prevent you from having a title claim. And one of the values of title insurance is the work that we do before the closing to make sure that when you purchase the home, it is free and clear. And as many of the risks are eliminated as possible, or as many risks as possible are eliminated. And that way, when you purchase the home, you have that peace of mind of knowing that something's not going to come up after the fact. And if by some chance, a very, very rare chance that it does, unless you're Tonya Esquibel, then you get struck by lightning twice. then your title insurance company is there to help cover any legal expenses or any of the costs. Or to pay out of pocket for a lien or anything that could come up. They're actually indemnifying you against any of those kinds of expenses. So the title insurance policy, like I said, you have to buy one for the mortgage company whenever you purchase with a mortgage. You can insure yourself for like $50 more. And a lot of times, especially in a market like this, the seller pays for the title insurance policy. You don't even have to pay for it.
I know. And they weren't getting that. So.
They weren't getting that in 2021.
Nope,
no.
They weren't. All right. So thank you so much, Kim, for taking your time this Saturday. And I'm excited because as we get into October, I think you had mentioned wanting to do some fun themes about the horror stories of real estate as we get into the holiday, as we get into a Halloween weekend. I think that will be fun. And that could be title too. That definitely you can have a horror story. Yes. And obviously there's always mortgage stories, real estate stories. And so, but some of the funniest horror stories I've ever heard has actually been from title companies because you're the last ones that see them. And You're giving them their keys. So a lot of it is like we've talked about is like such a blessing.
Yes.
Because you're like, yes, here's your keys and sign. But then if you've got this going on over here, it could go really sideways really quick. So excited that we'll be bringing that. So continue to stay tuned. If you have any topics that you would like for us to talk about, please call us or text us 615-300-0794. Also check us out on Instagram, social media, podcast, Spotify, YouTube, TikTok, Instagram, Facebook. We've got all the information out there to help provide you with the wealth of knowledge when it comes to investing. And one of the biggest things you're going to invest in, and that's your home. So have a blessed week, and be sure and tune in next week to the Tonya Esquibel Real Estate Show right here on Super Talk 99.7 WTN.